Hi everyone, so today I'm with Dom and we're going to be doing an earnings update video for CrowdStrike for Q4 of 2026. Dom, whenever you're ready.
All right, can you see my screen?
Yeah, perfect.
Awesome. I just want to highlight really quick before we start with the review. The article has the wrong year, so it is Q4, but it should be Q4 of 2026, like Matt mentioned. We even double checked on CrowdSource's website, and its own website also says Q4 of 2026. So just a little typo on this article, but it's definitely for 2026, as we kind of already looked at. So with that little caveat out of the way, let's dig into it. So revenue, they have at 1.31 billion versus analyst estimates of 1.30 billion, which is a 23.3% year-over-year growth or a 0.6% beat. Not bad. Adjusted earning per share is $1.12 versus analyst estimates of $1.10, a 1.6% beat. Adjusted operating income is at 325.8 million versus analyst estimates of 317.2 million, which is a 25% margin, a 2.7% beat. The revenue guidance for Q1, again, they mentioned the article put the wrong year for the previous year, so they're going to have the wrong year for this guidance revenue. So it should say 2027. So it says revenue guidance for Q1 of 2027 should be 1.36 billion at the midpoint, roughly in line with the analysts were expecting. Adjusted earning per share guidance for upcoming financial year. See, and then it says 2027. Interesting. Is at $4.84 at the midpoint, in line with analyst estimates. Operating margin is at negative 0.5%, up from negative 8.1% the same quarter of last year. Free cash flow margin is 28.8%, up from 24% the previous quarter. And then finally, annual recurring revenue, they say, is at 5.25 billion, which is 23.8% year-over-year growth, which is a beat. I would say overall, they actually had a pretty good quarter. They did beat on them, some of the main metrics to typically look at, earnings per share, revenue, things like that. Wasn't like crazy by any means, but still beating a lot of estimates, a lot of the key areas that we're looking for.
Hmm.
So overall, not too bad. So we'll switch it over to Matt, and he'll take a deeper dive in their current financial situation, and we'll see how that's going.
All right, great. Thank you, Dom.
Thank you.
So, like Dom was saying, they actually had a pretty good quarter overall. And I want to first take a look actually at their net income or their GAAP profitability for the full year, because it didn't mention in the article specifically for the full year. And just so people are aware, for the full year 2026, this is what Dom just reported as well on this quarter. So they reported a GAAP net loss of $162.5 million. Last year, it was negative $19.3 million. So just so people are aware that the company currently technically isn't profitable. That's due to a lot of stock-based compensation that they have to recruit good talent and give them stock options, essentially, more or less so. And this is just it clears maybe a little bit more of the confusion here. So the net income, we could see the track here. This is for full year 2024, full year 2025, and then it has an updated, not quite yet for the full year of 2026. It's not negative 314 million. So just so people are aware of what's actually going on in the company, they aren't profitable. They only had one full year profitable. That was in full year 2024. So just for the clarification there. Now, with that being said, the numbers do look good, and we're going to first take a look at simply Wall Street. So right now we have 1.2 billion in free cash flow. The next 3 years, 3 billion. So clearly more than a double. Really good on that. And keep in mind, this is a $108 billion market cap, so it's a big company too. But they aren't profitable, so always keep that in the back of your head. The financial health of the company does look excellent as well. A lot of cash, a lot of equity. Debt has pretty much calmed down. Looks really good overall. Again, no complaints. Now, when we take a look at how much is the stock, well, if it's over or undervalued, it's overvalued by 16% based on historical growths. Uh, yeah, it's pretty expensive, I would say. Looking at Wall Street forecast, Wall Street's going to say it's 58%. I think this is too bearish. I think historical growth is more in line. I do believe it's overvalued because the growth rate is still there for the company. They're growing at an incredible rate, but it's just really expensive. Now, the stock where it's trading at, which is always a good question to see, it's 428, or we could just round it up, 429 right now. 52-week high 566 and a 52-week low of 298. So certainly on the higher side, which again I agree with alpha spread, and we're going to see with Tipranks that it's pretty much going to concur the whole presentation, and it's going to be a moderate buy. We have 25 buys, 10 holds, 0 sells, an upside of only 12%, a low of 368, and an average of 481. So it's certainly near that. I would probably wait for a big dip. I know it did dip because of the software sell-off going on, but I mean I like the company. Just my problem is not profitable yet, and it got more into being in the negative territory of net income, so it doesn't look great. I would, and the price is very expensive, so I probably would certainly wait for this. Dom, is there anything else you want to say?
No, I think you hit it pretty well. There's nothing else I can really add to this one.
Okay, great. Thank you, Dom. Thank you, everyone.